Good morning, everybody, and welcome along to our Scottish Economic and Fiscal Forecasts webinar that summarises our work that we've done to accompany the Scottish budget. So I'm Graham Roy, I'm Chair of the Scottish Fiscal Commission, and I'm joined today by three of my colleagues, so Eleanor Ryan and Justine Ricomini, my fellow commissioners, and also Claire Murdoch from the Commission team. And we'll be here to talk you through our latest forecasts about the economy, taxation, social security, and we'll talk about the overall funding envelope for the government as well. And then we're going to open up for questions and really keen to get your input and to pick up any questions or any comments that you have on our work. So for that, what we're going to do is we're going to use Slido. So we've got the Slido code here. So there's one of two things to do. One is you could go to the Slido web link and then type in that code, or you can use the picture there, the QR code, to scan in, and that will take you to today's question and answer section of the webinar. And what we'll do is I'll just give you a brief overview about some of the core insights from our work that we published last week. And then we'll move to Q&A and we'll go through and try and get through as many questions as possible in the hour that we have. So just to kick it off and to give you an overall flavour about the Scottish budget and the outlook for the next few years. So what I've got here is just a table that projects total funding over the course of the spending review that the government has set out up to 28-29. And what this table does here is break it down into a couple of elements for you. So the top three lines are relating to total funding, so the entire allocation that the Scottish Government has. And then the next couple of sections look at day-to-day funding, so resource funding, and also a subset of that, which is the day-to-day funding that is available for public services, once you account for the fact that an increasing element of the government's day-to-day funding goes in social security. So I'll talk you through the core elements of that. So what is projected next year is that the government will have just over £61.6 billion to spend in 26-27. That's nominal growth, or cash growth, of 3.6% relative to this current financial year. When you look at the resource spending, the cash increase is pretty similar. So it's cash increase of about 3.4%. But once you start to adjust for inflation, you account for the spending power and look at the actual ability of the money to have an impact. Once you account for rising prices, the increase between this year and next year is only 1.1%. And you'll see as you go through the next few years that growth is projected to be exceptionally limited over the next 2 to 3 years. And actually, over our entire forecast period of 5 years, we're projecting day-to-day real terms growth funding of just over 1%. And that is exceptionally tight for the government. That's going to be exceptionally challenging for the government to prioritise where its spending is going to be allocated, because the overall resource capability, the overall resource capacity of the government is so limited. It actually becomes even more limited when you look at what is left for public services, once you account for the fact that social security funding is increasing significantly. The actual real terms growth for public services funding is only going to go up 0.2% next year, and actually to slightly fall in 27-28. So that's an overall quite challenging fiscal environment for the government over the next few years. That's the resource budget. What's happening to the capital budget? And again, the top part of the line here is just to give you an overall flavour, again, of the total funding environment to compare it to. So there's that 61.7 billion that I was talking about earlier. If you look at what's happened to capital funding is growing and actually grows quite significantly this year. So real terms growth of just under 3%, 2.9% between 25-26 and 26-27. But just look what happens as you move through the period that the government has set out their spending plans for. Is projected to fall in real terms year on year all the way up to the end of the decade. And that again just sets a really quite challenging overall fiscal context for the government to prioritise the capital plans that they have. And one of the big reasons for that is the block grant that the government relies upon from Westminster for capital investment was essentially front loaded in the UK spending review. So we had quite significant increases in the early part of the UK spending review, but that falls away as you move through the decade. And that's one of the overarching context that the government have set out their infrastructure pipeline and had to make some quite difficult decisions about what they're prioritising and what they're focusing upon. So just to explain a bit more about some of the issues or some of the context that the government are dealing with in terms of their overall funding outlook. So this just puts the overall increase in the resource budget in graphical form, so you can see that increase over the next few years, right up to the end of our forecast period, which is in 2030 to 2031. And you see that that growth in real terms is going to be challenging. So in total, the increase is only going to be 5% over that time, so that 1.1% each year. To help with this, the government are using pretty much all the flexibilities that they have to help unlock additional funding and to smooth funding as much as possible to help spending in each and every year. So, for example, they're planning to put money into the reserve this year, so to underspend in 25, 26 in order to shift money into 26, 27 to help boost spending in that year. They're also planning to draw on Crown Estate revenues. So these are largely the revenues that have become from ScotWind. So that's the selling of licenses for offshore renewable generation. There's essentially a pot of money that the government have that they can spend, and they're planning to try and utilise that, or at least planning for the potential that they may utilise this over the next few years, both on revenue and capital, in order to try and prop up spending as much as possible. Of course, the challenge is that once you spent that money has gone. So the government are trying to use all the flexibilities that they have. They're also drawing in the NDRI pool early on in the forecast horizon, and they're also looking what they can do about any shifts between revenue and capital to try and prop up the capital budget that is particularly challenging in a particular week. So there's a lot going on under these kind of headline numbers, but the core point, I think, is that the government are facing quite a tight fiscal envelope over the next 3 years of the spending review, but even into the next couple of years of the subsequent spending review. So that gives you an overview about what's happened to overall funding. As we mentioned, the government has set out a spending review as well. So they've set out plans for 26, 27, but they've also gone further and set out indicative spending plans all the way up to 28, 29. And we've been able to unpick and have a look at what the different components and where the prioritisation of the government has been and in the past and also going to be into the future. And in that regard, the story is pretty similar to what we've had before, in the sense that the government are prioritising the portfolios around health and social care, social justice, which includes social security. So this is really things like passing on Barnett consequentials of increases in health spending in the rest of the UK, prioritising social security, so rising prioritisation in terms of things like Scottish Child Payment, disability payments, and the like. And one of the key takeaways for that, I think you can see quite clearly from the graph here, is where that relative prioritisation is going. But one of the implications of a budget funding envelope that is exceptionally tight, so that real terms growth of only around 1% over the next 5 years, if you choose to prioritise areas such as health and social security and social justice, it means that all other aspects of the budget are going to have to pick up the slack, either with relatively limited growth or with potential real terms cuts coming over the next few years. And you can see that here, where other portfolios outside of these big two in terms of health and social justice, many of them are projected to fall in real terms over the next few years, with the biggest adjustment coming through in terms of local government. One other thing I would say about these plans and what underpins all of these plans is that the government, alongside their spending review outputs and their settlements for each portfolio, have also set out some quite ambitious efficiency savings that underpin essentially the allocations that have gone into each portfolio here. So in total, the government has spoken about efficiency savings over the next 3 years of £1.5 billion through various different mechanisms they want to try and achieve that. And within that, about £1 billion of that is going to be coming from the health and social care portfolio. So really quite big numbers and ambitions by the government to essentially have a spending review, but to have the allocations in that spending review underpinned by quite bold reforms and public sector reforms in order to essentially make these spending allocations all add up. Obviously, we highlight that as being as a bit of a risk. It's also an opportunity, of course, but it is a risk in the sense that if the government don't meet or are unable to meet the efficiency savings that they hope to achieve, that then begs the question about how realistic are these allocations and what might have to happen potentially to adjust these. Another risk we highlight is around pay and the public sector workforce. And there's several different elements to that. And why is that important? Well, it's important because around half of the Scottish budget is spent on pay. So anything that happens on pay or workforce has quite a significant impact elsewhere in the budget. And as I said, there's several risks in this. So the first risk is that the government's pay award, which if you recall last year was for pay awards over the next 3 years of 9% in total. We're about to go into year 2 of that pay award, and the government have used up quite a lot of the allocation in pay awards that they said that would be happening over the 3 years. So we estimate that given the pay awards that have happened for 25-26 and then 26-27, in order to maintain themselves in that 9% pay policy over the 3 years, that would imply that for 27-28, you'd really be looking at a pay deal of around 1% in cash terms. So essentially a pay cut in real terms for the public sector. And that's particularly even more so within the NHS, where awards have been even higher. That would require an even more significant real terms cut in NHS wages. And whether that is achievable, whether that's desirable, whether that's deliverable is a significant risk within the budget settlement. The government have also set out ambitious targets to reduce the public sector workforce. So in total, we think over the next 5 years, that will amount to around about 13,000 jobs. Crucially, any shakeout in jobs, so any reduction in jobs is going to be targeted at non-frontline workers. They've not fully defined what that means by frontline workers, but that's where the focus is going to be on everybody else except teachers, nurses, etc. Of course, that then means that those 13,000 jobs that you have to find is then being pulled from a much smaller group of public servants, and that means the adjustment is going to be more significant. So we highlight in our report and our work that this is all underpinned by the government really being quite upfront with the fact that they plan to drive efficiency savings, change the way public services are delivered, and also change essentially the size of the public sector workforce as a result of that. And that then all brings implications for how you deliver that and what the impacts are for outcomes. So that's the overall kind of picture on funding and spending. And what I want to do is just walk you through our forecast on the economy, tax, and social security and pick out some core elements for you. On the economy, we haven't really changed our assessment of the economic outlook. Clearly, as anyone can see from the news, even over the last few days, the economic outlook is highly uncertain. But we thought that this time last year. So we haven't really changed our forecast. We still think that the outlook is highly uncertain. Clearly, if things were to escalate into a more difficult trade war, then that would have an impact on these forecasts and have an impact on the overall economic outlook. But we've maintained broadly our forecasts from last year. On tax, obviously there's a kind of raft of announcements and changes in tax. I just wanted to highlight a couple of things for you here. One was around the income tax net position. So you'll recall that under the fiscal framework for Scotland, essentially the contribution of income tax to the budget depends not just on how much income tax is raised in Scotland or how or what Scottish ministers choose to set in terms of tax rates and tax bands, but what also matters is essentially how that Scottish income tax revenues are doing relative to the rest of the UK. So in other words, how are rest of the UK tax revenues doing? And what we've seen is essentially that net tax position move around, but the core line to focus on here is the green line, which is our revised forecast for the income tax net position. And we project that next year the income tax net position will be just shy of around £1 billion. So that'll be adding an additional £1 billion into the budget as a result of essentially the Scottish Government's decisions to raise income tax relative to the rest of the UK. One thing that is perhaps interesting to have a wee look at is that you see that our forecast suggests that's going to be a positive net tax position in 26-27. If you can see, just looking carefully at the chart, if you compare that to the dotted red line, you'll see that it lies slightly below the dotted red line. So in other words, we were forecasting a stronger, more positive net tax position this time last year than we are just now. So the question, I guess, is why do we think that net tax position is less positive? Well, interestingly, the reason for the change isn't so much something that we have done in Scotland or a specific policy choice that the Scottish Government has made or our assessment changing of the Scottish outlook. What's actually happened more is a change in the outlook within the UK context. So the green bars here are our forecast for earnings for next year. The purple lines are the forecasts for the UK earnings for next year, and they're made by our sister organisation, the Office for Budget Responsibility. And what you see is the difference between our previous forecast and our latest forecast. For us, we've not really changed that outlook, but for the UK, the OBR have increased their assessment of earnings across the UK. And that's the key explanatory factor by why we have this slight reduction here you can see in the chart between the net tax position we said last year and the net tax position this year. And I think that's quite important, and it's quite a useful indication, a reminder for us all that the Scottish fiscal devolution doesn't just depend upon what we say in the Scottish Fiscal Commission or what the Scottish Government say in terms of tax policies. It also crucially depends upon what happens at the UK level as well, because of these interdependencies and these interconnections. And a key reason why the net tax position is less strong for Scotland next year is because of changing forecasts at the UK level. So that's income tax and the overall net tax position. What about changes in the kind of the tax policies? So the government announced a couple of tax policies in the budget related to income tax. The decision to have these increases in the thresholds for the basic and the intermediate rate, so that increasing these rates, so essentially like a tax cut that cost the government a limited amount of funding, but also again the indication that they plan to freeze the threshold, confirm the threshold for the higher rate and above will be frozen in 26-27, but also once again in 27-28 and 28-29. And one of the things that I think we want to be just highlighting is that one of the key ways that the government are increasing revenues in Scotland relative to the rest of the UK and using the revenues to generate this net tax position is largely coming through this effect called fiscal drag, whereas people's earnings go up because the thresholds are not keeping pace with growth in people's earnings, more people move into higher rate tax brackets as they go. So back in 2016-17, around about 300,000 people in Scotland were classified as being higher rate taxpayers. So that was essentially the number of people that were paying the higher rate threshold, the higher rate of tax in Scotland. Jump forward to our projections for next year, and we think that instead of 300,000 people in Scotland being higher rate taxpayers, we think that will be over 800,000, so over 830,000. So that will be 830,000 taxpayers in Scotland paying at least a higher rate. There'll be other people within that group paying the additional rate, the top rate, the advanced rate, but the at least paying the higher rate threshold has increased by over 500,000 people in Scotland. And that's quite interesting because it's changing the interesting structure within how tax is shaping the income distribution. So now over about 1 in 4 taxpayers in Scotland are now going to be paying the higher rate. So that's an interesting kind of dynamic that has emerged in Scotland over the last few years. You can see from the chart, the table there, that that's a trend evident also in the UK, but it's more pronounced in Scotland because we've frozen the thresholds at lower rates. So one final thing just to pick up and to discuss is Social Security, so the other core element of the Scottish Government budget. A reminder, the way that works is that Scottish Government can essentially introduce new payments if they wish within Scotland around Social Security. The Scottish Government has also now got responsibility for some payments, largely around disability and ill health, that used to be delivered by DWP but have now been essentially closed off in Scotland and are now delivered here in Scotland. And for that, they get funding for that. And that's what that BGA funding relates to in the chart. So a block grant adjustment. So the block grant is adjusted up for the fact that these payments are now delivered in Scotland rather than in the rest of the UK. And there's a couple of trends that are quite interesting here. So first of all, you see it's increasing. So both in terms of spend, but also in terms of funding. And again, that comes back to my first point, talking about what was happening to the overall Scottish budget and the prioritisation there. Secondly, you'll see that there is a wedge between the block grant funding and the total amount, which I've highlighted here in green in terms of extra funding. And that's essentially the additional spending that the government are the commitment they're making over and above the funding that is flowing through to deliver equivalent levels of social security from elsewhere in the UK. So the government essentially having to find additional investment in order to uplift the amount that they want to spend in social security relative to that funding. And that's things like the Scottish Child Payment, that's things like the different rollout of some disability payments in Scotland that are leading to higher inflows and higher people coming into these payments relative to the trends that we've seen at the UK. And that means that overall, what you have is a difference between essentially the funding that is being flowing through from the UK government for social security and the overall amount that the Scottish Government are choosing to spend in this area. And that, of course, means that additional investment in social security means that has to be essentially funded from other areas, whether that be spending or whether that be taxation. And one final point I just want to end on, again, it comes back to my point about taxation and the differences between the interactions between UK funding and Scottish Government funding and the complexities within the fiscal framework. You'll see that the difference between the funding and spending that we're now projecting in January is quite different from what we were projecting back in December and also June last year. And there's 3 key elements within that. So firstly, one element is we made some revisions to our forecasts around take-up and payments and the like. But crucially, what we're also seeing is UK government changes to policy leading to essentially more funding than otherwise would have been the case. So the classic one you'll probably know about is that jump back to spring last year, the UK government announced plans to make significant savings in PIP, in personal independent payments. If they'd followed through on that, that would have reduced the funding for the Scottish Government budget, which led to a bigger gap between that funding and spending forecast. And that underpinned our forecast back in June last year. But then also on top of that, we know that the Scottish Government had plans to mitigate the two-child limit. That was going to cost them around about £180 million. Since the summer, we now know that the UK government is actually going to essentially abolish the two-child cap within universal credit. So that now means the Scottish government no longer has to spend the money on that policy because the policy has already been changed at the UK level. And just to give an idea about the scale of that, if you put both of these together, by 29-30, so by the end of the decade, that was around about £500 million of savings for the government don't have to make in terms of the PIP reforms. And it also means around about £125 million of savings within the two-child limit. So there's quite a significant amount of money that the government could have had to have found that because of UK government decisions, they no longer have to find these savings. And that improves the kind of the net position from a public finance perspective. So hopefully that gives you a broad overview of our report and some of the key insights that we've picked up on. What we want to do now is move to Slido. So as I said, we have the code here. So please do feel free to put in the code and then type in your questions or use the QR code and you can access the same website. And what I'll do is I'll stop sharing my slides just now and then we'll open it up to questions and I'll bring in Justine and Eleanor as we go. Great. Okay. Right, here we go. So we've got some questions here that I'll just try and run into. So Justine, maybe I'll come to you first if that's okay. So there's a question around, have we captured behavioural effects from the Scottish Government's decision to freeze income tax thresholds into our forecast? So maybe you could explain just how we do that, if that's okay.
Yes, thank you, Graham. Hello, everyone. So in terms of behavioural responses, we do model behavioural responses and that modelling is based on international evidence. But at the moment, we would say that we feel reasonably well reassured that we haven't seen any evidence to suggest that our current modelling contains any significant errors. And it's always kind of quite difficult to tell in terms of behavioural responses because some of them, from an income tax point of view, what people, because the behavioural responses do tend to be at the higher end of the earnings scale anyway, if there are going to be any. If people choose to change their behaviour, it's not always visible or at least immediately visible in a lot of respects because people can choose to do a number of different things to try and mitigate the tax that they might be going to pay. So that could be something like putting more money into a pension, or perhaps deciding not to take that promotion because they'll be going into another band or something, or restricting the number of hours that they work. Just different ways of looking at things from their personal perspective and what they want to do with their money. So the way that flows through into the information that the governments get in the UK and also that we then get can be difficult to analyse because it doesn't necessarily appear in real-time information returns or self-assessment returns. It's not necessarily compulsory to put something in the white box on your self-assessment return to say, I've decided to change my behaviour and I want to pay less tax. So we have to look at the figures as they come through and try to make judgments on that. And look at how does there look as if there is an element of behaviour in there? I hope that answers the question.
Yeah, it does. Yeah, Justina, and I think you've made as well as before is that the ability to change behaviour changes as people go up the income distribution. So that's why we have higher kind of behavioural effects in our assumptions for really top earners rather than
That's right.
somebody in a earned salary job.
Yeah, I mean it's we've had this debate for many, many years in tax policy circles around whether people can choose to modify their behaviour or not. And obviously people at the higher end of the earnings scale can be more mobile if they want. They can move, they can, do other things. But also it's totally subjective. What some people think is a tax rip-off or a stealth tax or whatever, other people don't think that at all and they have a completely different point of view. So that's where the difficulties come in.
Okay, great. Thanks, Justine. So there's a specific question around the private jet tax that was alluded to within the budget and feeding through to air departure tax, and when will our forecasts, etc., begin on that? So, I mean, so typically, just maybe Claire, you might want to come in the specifics around the dates and stuff, but typically what we do is that once we have a concrete policy from the government, we'll then sit down and model it, and we'll then assess what the effects of that would be. So it's not unusual for the government to highlight some plans or some expectations or some high level ambitions to introduce a tax. It's only really when it moves into being an actual policy, and sometimes that can involve changes in legislation, but it can actually then usually involve really quite detailed tax work to design it. At that point, that's when we would make our assessment. But I don't know whether Justine or Claire, you want to maybe come in on the specifics of the dates, etc.
So at the moment, the Scottish Government are planning to introduce air departure tax in April 2027, and then they will be setting the tax rates in the budget next year. Well, I say next year, it's this year now, we're in 2026. So the 2027-28 budget will set the tax rates, and what the government have said is in the first year they will match what the UK government rates are for that year, which gives some certainty for airlines in selling tickets and things like that. And then it will be from April 2028 that the new tax rates will come into effect, and those should be set out in the budget next year.
Okay, great. Thanks, Claire. Eleanor, maybe if I could come to you, there's a slightly kind of um, question just picking up on the election, and obviously we can't talk about the details of the election or what happens, etc. But there's just a general comment about what weight should anyone give to a spending review in advance of the election, and you might want to use this as an opportunity, to, I guess, to expand more broadly on public spending and what we're seeing in the trajectory for public spending.
Yeah, thanks, Graham. I'm happy to do that. So I think it's entirely fair to point out that spending plans may change post an election, but spending plans may change anyway. And I think one of the really positive things here is the government has carried out a spending review. They've set out their plans. It's always better to have a set of plans set out over multiple years, even if those have to change later, then everyone understands where they are because they know what was planned and now what's been changed. So I think that's a big step forward. I think we would have preferred to see more detail in the plans that have been set out. We've really only got figures at don't want to get too technical with what's called level 2 in the budget, but just basically at a high level in the budget. When you want to get further down into individual smaller bodies or individual smaller spending areas, we haven't got all that detail, and it would have been really good to see more, but it, nonetheless, it's a big step forward. An incoming government will have to decide how far it wants to and how far it can live with the plans that have been set. I mean, as Graham has already highlighted, the budget is really very tight. I see someone else has asked a question about gaps as well. If I pick that up while I go. So there's been a lot of talk about budget gaps. Last year, the Scottish Government published its medium-term financial strategy, and that was based on its projections of spending based on its policies, priorities, commitments, and then the projections of funding at that time based on our latest forecasts at that stage. And that was showing quite significant gaps in future years. Obviously, what's been set out now by the government, because it is required to balance its budget each year, it's set out spending plans which match the funding that we have now forecast over that period. So where has the gap gone? Well, the gap is effectively hidden, and the government has set out plans around efficiency savings. You have probably heard a figure of 1.5 billion of efficiency savings. That's a big component of having set these plans. People have to live with them. They have to deliver within that amount of money. And in order to do that, they have to make efficiency savings. They have to reduce the workforce. They have to, all the things that we've already been discussing. So the gap will never be obvious when you set the plans like this. What's really critical is how the government delivers on, the government and all the public sector delivers on all the things it needs to do within the budgets that have been set. And that's where the gap's gone. That's where the pressure there to manage to do all the things you need to do within the spending limit. So going back to the original question about wait ahead of an election, an incoming government will have to review all of this and decide whether it's happy with the plans as they stand. It might want to change them, but it's still a significant step to at least have a plan that you're working to.
Mm-hmm. Yeah. And maybe, Ellen, if I could come back to you on that, because there's another question which I guess follows from that, which is there's a question around how likely they are to deliver on efficiency targets. And there's a question about how credible they are. And we probably wouldn't go into too much detail about that. It's all for the government to do. But I think there's a really interesting bit that you might want to comment a bit on that. But the bit that I guess is quite interesting is one, is further detail required on that around, you've mentioned a bit on spending, but I think there's further detail needed on efficiencies. And secondly, what's the implications of not meeting these efficiency targets? Yeah. What might be the effect on the budget or the spending review plans?
Yeah, thanks, Graham. So, as you say, we don't scrutinise the plans, the efficiency plans, but all the things we've been saying about funding and relatively slow real terms growth in funding, all the pressures around pay, around workforce, and around the gaps that were previously identified, it's no doubt that it's challenging. And so it will be really important for more information to come out to allow Parliament, to allow public to understand over time how well the government is doing on delivering against these plans. If it can't do so, then it will have to make other changes in order to continue to balance. We're back to this issue of the government has to produce a balanced budget in every year, and it has to live with very marginal tools, with some very limited borrowing powers, and reserve and so on, which are really quite small given the scale of the budget. The government has to find a way to balance its budget for each year. And so if some area of your efficiency plans can't deliver, then you have to find offsetting savings somewhere else, or you have to think about whether there's any other sources of revenue. But again, they are very limited. Mm-hmm. So it will be challenging.
Okay, great. Okay, thanks, Ellen. So I'm going to come back to you on another one, which is in a second, just related to climate, but also Justin, maybe on infrastructure. But there's a question here specifically about bonds and the plans for the government and bonds. So just to be clear to everyone, so there's two things on the go here. So the government have obviously announced an intention to explore the options of issuing a bond at some point into the future. They've also gone out to credit rating agencies to get a credit rating, which they now have. In the current plans for the budget set out, the government have said that their expectations are based upon still continuing to use the National Loan Fund, but clearly that can change within the year. A point I think, Eleanor, you made this morning at our session with the Parliament is that it's really giving you the opportunity, isn't it, to change the flexibility within how you borrow, but the limit is still fixed by the fiscal framework, and that's still how much you can borrow over time. Great. Okay, so maybe if I can come to you, maybe first, Justine, on on infrastructure. So there's a question here about is there unity between the budget, spending review, and in your case, I'll maybe come to you on infrastructure, and then maybe I'll come to you, Eleanor, on climate. So Justine, so I guess, is there a link between budget, spending review, and the infrastructure plan?
Thank you, Graham. Yeah, in terms of infrastructure, certainly, I'd like to think so. I think we've got, from reading the Scottish Government's infrastructure delivery pipeline document, which is available on the Scottish Government's website, it kind of does contain some detail as to which projects are coming up, and for which some of which have already commenced, which funding has been put aside for. They're all contained in the first annex, which is called Annex A at the back of that document. And they do list projects such as, the prisons that are going to be there's constructions underway, I think, in Glasgow, certainly anyway. And also things like the ambulance replacement programme, which is a huge piece of spend, and things like the peatland restoration programme, just to give a sort of overview of some different areas there. So they're definitely happening. And then we have another annex at the end of that document, which is Annex B. And there, where a business case is being developed for those, or an outline business case is being developed. So it's not necessarily clear at the moment which of those will be in future spending reviews. So we can't necessarily map that at the moment. And the other important point is that it doesn't really cover any costings that might have been developed for those, don't really cover things like maintenance costs. So it's quite difficult to match up the figures at the moment. I'm not saying that won't be the case in future. And then Annex C of that document is essentially a kind of flowchart pipeline thing that takes something through it from being a conceptual issue right through to delivery and transition. But the difficulty with that annex is that there aren't any actual timelines contained in it. There's a couple of initial timelines that are set out at the beginning of the document, but not really sort of in any great detail or depth. So that's where we are really with the infrastructure delivery pipeline. There isn't really very much else to say.
Yeah, and I think that was something which came up at committee yesterday with us. We were being probed on, so that'll be interesting to see what more the government set out over the coming weeks and months. But Eleanor, I was going to just say that so there's the question, just expanding that question and saying, well, is there a link between obviously infrastructure, but then onto things like climate? And I guess you could look at other things like child poverty and things like that. I mean, how well linked do you think, or what insights can we add in terms of the linkages between what the government have set out through the budget spending review and then the key policy outcomes that they're trying to achieve?
So I personally don't think we can add a huge amount of insight, because the point I was making earlier about the spending review plans that have been set out and the level of detail of the spending review plans, you need to go quite a long way below the kind of high level figures to understand the spending on these different aspects like climate, like child poverty, and so on. I'm not saying that they don't all link up. I'm just saying I don't think we can tell based on the figures that we have seen publicly. And so I think explaining how this package of the high level spending review plans, the efficiency plans, the infrastructure, how it all comes together in some of these big policy priorities and what that's going to mean in practice is going to be a really key issue for scrutiny over the coming period, and probably going through into the election as well.
Yeah, and just while I've got you there, Eleanor, there was obviously a bit of a issue around budget comparisons again this year, and comparisons between autumn budget revision, routine transfers, allocations for next year. Can you really just try and briefly summarize what that issue is and actually what the challenge is that it poses this year?
I can certainly try. So over really a number of years, there have been issues where money is set out in plans in a particular portfolio because they have a policy responsibility, but the delivery part happens in a different portfolio. So a good example would have been health and social care with integrated joint boards and so on, where money might have been allocated to health and social care, but in the end, each year, a portion of that would then transfer through to local government because they are the ones who are going to actually deliver on the ground and they're going to spend the money. And there are quite a lot of these. Government, let's face it, is complicated. And there are quite a lot of these across the Scottish budget. The trouble is they make it very difficult to compare things year on year, because if you can just look at everything that was published at budget time, but then other changes happen in year, and if you want to use the latest figures, and you've had these big transfers, but then you're comparing to next year's budget and those transfers haven't yet happened, you get misleading comparisons. So if that big money that was sitting with health gets transferred to local government, and you try to look at the health budget and the local government budget from this year into next year and beyond, you can get misleading comparisons. Now, the good thing that the government have done is that they've started to baseline some of those transfers. So the one I mentioned are particularly big transfers around health and social care. So that money has been moving around so that these comparisons are more, are better year on year. But there's still around £600 million worth of transfers that are routine, that are anticipated in 26-27, but they're not reflected yet in the figures in 26-27. So if you take the latest spending figures for 25-26 from the autumn budget revision, and then you compare them to next year, you get, again, these potentially misleading, less so because the government have improved things, but still potentially misleading comparisons. So in the Fiscal Commission document, we have adjusted we've actually adjusted the figures for 25-26 to strip out the transfers, not to reverse the transfers rather, not adjusting the figures for 26-27 because we don't necessarily know the precise amounts for 26-27. So it makes a big difference on, for instance, health or local government or education and skills when you do the comparison with or without taking account of those transfers.
Right, excellent.
If anyone wants to look at the exact numbers in figure 4, we've got spreadsheets, so any sort of slightly technical nerds out there can go through it and work out exactly what the effect is per portfolio.
Great, thanks, Claire. And I think I guess just to build on that, if you look at that table, one of the ones that does have an impact is if you look at the day-to-day resource budget for local government, then according to the Scottish Government budget presentation, that's projected to go down in real terms next year. If you look at our comparison, which makes these routine transfers, it actually goes slightly up next year. So it does have material impact on that. And I guess within that, there's a next question about local government and what's happening to local government, third sector, and the follow through. And while local government resource budget might be going up next year, if you look over the course of the entire spending review, then in our projections, it's a real terms cut. So maybe if I just take this one just to explain a bit about our role for people here, and Eleanor, you might want to come in on some of the specific allocations, but we don't forecast local government. So our remit is national government, our remit is national taxes. So on the point about whether or not will they need to have council tax, for example, we don't actually forecast council tax because that's entirely up to local governments. It's up to them, and similar in the third sector organisations who might get funding from local government, then that's ultimately a local government decision that doesn't sit within our remit. I guess the broad comment I would make is that going back to my arithmetic point at the start, if you get a really tight funding envelope and that is being pushed into health and social care and social security and social justice, it then means that the other parts of the budget, including local government, have to take up more of the slack. But Ellen, I don't know if you want to maybe add anything further on that in terms of the spending outlook.
I don't think there's really all that much to add, to be honest, Graham. I think, local authorities are going to have some very difficult decisions to make, I think.
Great. Okay. There's just going through. So there's a question here about health, and I guess it starts to get into reform. So what would happen if there's a big shift in health, for example, Scotland loses weight en masse, etc. So again, I don't know, Eleanor, you want to take that one first, and then I can maybe add something about our fiscal sustainability work that we do that looks at that. But Eleanor?
Yeah, thanks, Graham. Yeah, so in terms of, I think Graham's right. When you look at fiscal sustainability and you start to look at budget pressures, that's back to that whole issue of gaps, the gaps between the need and the funding available. Then you are into population health interventions and things that might help to close the gap. In terms of just the budget position, we have seen that the government has set out, as we said, these portfolio plans. Health is a huge part of that, but I am not aware of those having major public health interventions as part of the plan, and that probably is to do with timescales. So if you make a big public health intervention, lots of people lose weight or something, you will see a positive impact, but you might not see it in the next 3 or 4 years. So I think I don't think that in what we're talking about here in the forecasts and in the spending review and the spending plans, those things are there. But that doesn't mean they're not important. And obviously, preventative spend has been a very big issue for a long time, and more shifts into interventions, not just in health, that can actually reduce demand on public services over time will be really important.
Mm-hmm. Great, thanks, Eleanor. And I guess to complete the circle on that as well is that what you might see from a public finance point of view is savings being made in an area such as health because you're tackling obesity, or you've had an impact on alcohol consumption, or an impact on smoking, etc. But that may be recycled within the same portfolio, but it's now being used to invest in new drugs for other treatments and the like. So there might be a lot going on underneath the surface, but it might not actually be changing the overall public finances because you're be able to reinvest it. It's not to say it's not the right thing to be doing, and it's exactly the thing you should be doing, but now you're able to skew the investment and the spend that you've got into particular other areas. We've talked a bit about public sector pay and workforce plan, and a really good question about what is a frontline worker. So I don't know whether Justine or Eleanor, you want to maybe pick up if you happen to know what a frontline worker is, and maybe help us out.
I think that's really for Scottish Government to
Yeah, Justine.
Yeah, I was going to say, is this a confessional? Because I confess that it's very, very difficult to actually, unless somebody presents us with a definition of what a frontline worker is, it's quite difficult to just make assumptions. It was, I think, sort of COVID was a good case in point where we had the key worker concept. So we need to understand fully the implications of what a frontline worker actually is. I mean, there are some obvious ones that we can all think of, but it may well extend to wider than that. Eleanor, sorry, I did interrupt you. I'm sorry.
Okay.
No, you've covered it, Justine. Thank you.
Okay, great.
Sorry, just saying a bit about what the government's workforce reduction plans are. So the government has set its plans on the assumption that they have a 0.5% reduction in the public sector workforce each year over the next few years. And so we're looking at that being on a headcount basis around 13,000 people no longer employed. And if you take a definition of, a large chunk of the workforce is frontline, if that's protected, that's coming out of a relatively smaller group of what might be considered back office workers, which is going to be challenging for the government to achieve.
Mm-hmm. Yeah. Okay, thanks, Claire. So there's a really good question I want to come to just at the end for specifically targeted at Justine and Eleanor. So I'll come to them in that. But there's a question there about our remit and whether it should be expanded to enable analysis of the proposals of other parties. So maybe I'll just comment on that because we've just gone through a review with the OECD who looked at our remit and roles. So this is done by independent fiscal authorities in some other countries. It's not done overall. So for example, the OBR doesn't do it for political parties in the UK, but it is done in other countries where the independent fiscal authority would comment on the plans put forward by parties. And it's something which in principle you could do in Scotland. It's something in principle that you could do, that something an organisation like the Scottish Fiscal Commission could have a role in there. I think this is very much a personal view in that, in this, is that I think you have to be very careful to protect our independence and try not for us to be involved in kind of an election campaign, because ultimately we have to have a trusted relationship with government and parliament over time. So if we were going to do that, we'd have to be quite careful about how we managed that and managed the relationships to maintain independence, or the perception of independence, I should say. Also, as well, we have very good and quite detailed structured relationships with the civil service in the Scottish Government. So we have protocols, we have rules around information sharing, we have deadlines that are met, and we have a trusted relationship built up over many years with the government there. And obviously it's civil servants working collaborative, so they're protected and governed by the Civil Service Code. The minute you move into the more political environment, that becomes a bit looser, and it becomes a bit more a kind of open field. And again, we'd have to be very careful about what the rules and regulations would be around that. What information would we need? What information could the parties access? Because clearly the government of the day has got a huge resource they can draw on within the civil service to help inform their policies, but clearly political parties might not have that resource. So there's, in principle, I think it's a really interesting idea. The question would be is how would you do that in a practical way that that was deliverable? So there's a really good question. We've got 5 minutes, so I've warmed you up, Ellen and Justine. Is a cracking question, which is, for the new commissioners, is there anything that has struck you about Scottish public finances in your first few months in the role? So I don't know I don't know who wants to take that one first. Maybe I'll come to you, Justine.
Yeah, okay. Thank you. It's I could probably go on about this for a long time, but I won't. So I guess my main comment would be about the need for really good data and the need for really good detail, so that we can effectively do our role and at the commission and make sure that we can actually dig down into the figures. And we welcome all the improvements that are being made on a day-to-day basis. There's obviously been a lot of improvements over the years. I've been an observer of the Fiscal Commission's work for a long time before I ever joined the Commission. And I know that the difficulties that have been present throughout that time. So all I would say is, can we have even more data and even better data and more detail on expenditure and plans and things like that? That would be really fantastic. That's my wish list.
Thanks, Justine. And Eleanor?
Yeah, thanks, Graham. So some people on the call may know some years ago I was Director of Budget in Scottish Government, and I was Chief Executive of Revenue Scotland. I think and I was in Treasury a long time ago. I think my first observation was it doesn't get any easier, does it? I mean, the funding outlook continues to be really very challenging, and the operation of the fiscal framework, the techie stuff, the things that people probably don't want to have to understand about the way the rules work and everything that moves in Scotland relative to the UK and the impact of the UK government decisions and the impact of I think these things are really very difficult, and I think it's very positive that we're back to a scenario where we have multi-year spending plans. Yes, we can criticise, yes, we can say there should be more detail, and that would be undoubtedly helpful, but I think it's really healthy to be back in a place where we're trying to understand exactly how we're going to manage over multiple years. And the more, as Justine said, the more that can be done to increase transparency, the better that will become. So I think there's progress, but I'll finish where I started. It doesn't get any easier.
Okay, great. Thanks, Eleanor. So I'm just conscious of time. So we're going to conclude the webinar here today. So first of all, thank you, Eleanor, Justine, and Claire for joining us and helping us out. And also thanks to everybody in the audience who signed up and viewed the webinar today. A couple of quick things just before we go. On Wednesday, the 25th of February, we're going to publish a report highlighting the fiscal challenges for the next Scottish Parliament. So we're going to provide a broad overview about trends and the look ahead. That's going to draw on some of our recent work in the budget forecast, some of the work that we've done we might not yet had the chance to publish and share, but also some of our longer term work in fiscal sustainability. And then the following day, we're going to hold an in-person event in Edinburgh, and we're going to talk about this report. So if you'd like to attend that, then please do join our mailing list, and we'll send around details nearer the time and how to get tickets. And also, you'll hopefully have noticed that we started to publish much shorter insights on our website, where we basically provide a snapshot about something we think is quite interesting or something we think is quite important to understand. And we're going to continue to do that on a more regular basis over the coming months. So please do keep an eye out on our website for updates as we go. But at exactly 12 o'clock, thank you so much for joining us, and look forward to seeing everyone very soon. Thank you.